Mike Green, I'm here for Real Vision at the Real Vision Studios in New York City. Today we're going to sit down with another individual who is known for his work in the passive space, in particular his work on ETFs. Stephen Bregman has been on Real Vision before with an extended series called the Dark Side of ETFs, where he sat down with Grant several years ago. We're going to revisit that, particularly in the context of some of the stuff I've talked about. I'm really interested in how Stephen thinks about the end game of the passive strategies and how to think about the influence in the market. Let's sit down and see how this goes. Stephen, you and I have not had the chance to talk for a couple of years.
Yep.
You've been one of the other voices in the wilderness shouting about the risks associated with passive investing.
Yep.
I'd love to pick into your brain and understand the approach that you're taking to some of these challenges and some of the opportunities that are created by the growth of passive investing. And one of the places to start is kind of one of the areas of difference. So I've focused primarily around the indexing component, and you've spent a lot of time talking about ETFs.
Well, they're essentially one and the same.
Okay.
So sometimes people use the terms interchangeably because they don't know the difference or they're being casual about it, and I do the same actually. I deal primarily with direct individual clients. They're not institutions. Mm-hmm. They don't have an institutional mindset. And they're unaware of real differences. So they're unaware of the fact that asset management companies, Wall Street, is not really about investing. It's about asset gathering.
Mm-hmm.
They would be unaware, for instance, that how does an index come to be? An index comes to be because a certain asset manager that specializes in this might be under pressure from ever declining fees, and you can't charge a premium fee for a commodity product. Once upon a time, I think the fees on an S&P 500 index funds was what, 50 basis points, 60 basis points? Mm-hmm. Now they're down to zero.
Right.
So what do you need to do to justify a higher fee? Create something that seems to have, at least has the fig leaf of differentiation. So you can charge more for that, at least for a while. So you invent a new index. You do some back testing. You find some bucket of 20 or 30 or 40 companies that fit some theme that backtest well for the last 5 years. And by definition in this industry in modern portfolio theory, as applied nowadays, that means some positive rate of return with some relatively low comparative volatility, beta correlation, what have you, and then you can float a new index, and they're from offer an ETF against it, and you can't even get off the ground unless it backtests well.
Mm-hmm. Yeah.
So that's how that works. So indexes don't just come about because they're good investments. They come about because it's an opportunity for a management company to gather assets through a new ETF for which at least initially they can charge 45 or 55 or 65 basis points. And they can keep that fee, except if they're lucky enough to gather enough assets, not 10 or 20 or 30 or 40, 50 million, which is not even enough to break even. But if they gather, some hundreds of millions of dollars, well, then somebody else will come and knock them off, like Vanguard, mm-hmm. and drive the fees down again. People don't even get these basic concepts, and because my natural audience are individuals who really are the victims of this kind of asset gathering business that parades as an investment business, we study that.
Well, you and I originally started in the same space, right? So, you come up from the classic stock picker, single stock focus, run a highly concentrated portfolio, and by some measures, you found a few names that you think are truly extraordinary. We can talk about a few of them if you'd like, but your insight into ETFs that I know you from the grants conference discussions is largely around the dynamic of many different ETFs buying the same underlying products, right? And this tendency to overlap. And so you'll see very high representation of ExxonMobil. You'll see very high representation of other stuff. The dynamic you're talking about now, where effectively you offer a good back test to try to offer something that you can actually charge fees for.
Yeah.
And the potential for, if that gets to scale, either you to lower your costs so that new entrants can't come in and replicate it, or to be disintermediated by one of the giants in the industry, the Vanguard.
They're very disinclined to do that. They need every penny.
Yeah. So how do you think about this dynamic of the difference between a Vanguard model and a Blackrock type model, where they are charging rock bottom fees, and the need within the industry for innovation in order to kind of push forward how thought process is going?
The whole thing it doesn't even make a difference. There's no differentiation. The whole thing, I'm going to say something, it sounds incendiary. I don't mean it to be incendiary. But it's, well, I shouldn't say it's a lie, but it's false.
Okay.
The whole thing is a false premise. And now we actually have the evidence. So the evidence is in. So we now have a couple of things I'll mention. First of all, the great indexation passive investing ETF experiment, which took off for real more or less year-end 1999. And slowly at first, but it was given a real boost in the wake of the 2007, 2008 financial crisis, and people got really scared.
Yep.
They did everything that people do, which is act reflexively, which is not necessarily helpful, which is first of all sell their securities and memorialize a perhaps temporary loss. And then when they get back in, after there's confirmation that things are going up, which means they've lost the much of the recovery, that's normal. But what they did is they defaulted immediately to ETFs. They were there. They'd had time to become better known. They're a better mousetrap than a mutual fund. Mm-hmm. And people had been really traumatized. Traumatized, by the way, not just individual investors, but their brokers, mm-hmm. financial advisors, trustees of pension funds and consultants. They all were. And so they were scared of risk, all kinds of risk, manager risk, security-specific risk, everything. Mm-hmm. And so the proposition of an index made a lot of sense. So people had the experience. I could buy my favorite REIT. Maybe that's the one that goes to zero. Or I could buy an REIT sector mm-hmm. index fund, and it might not do well, but it's not going to zero. Mm-hmm. So that started taking off. So ETFs are supposed to be better, and indexation's better. And people like me could talk about it and analyze it and start coming up with very amusing and hopefully illuminating examples of how distorted it was becoming. It was still subject to a lot of argumentation that passive investing, which is supposed to benefit from the free rider principle, mm-hmm. we just want to participate in the wave of what active managers do when they contest in the open market and set clearing prices, and just participate without changing anything. We could argue that they're beginning to actually alter clearing prices, yeah. But that was arguable. We could argue that the only reason they were, or reasons they were outperforming active management, and there came to be innumerable articles about it, that active management has been proven to underperform indexes. We could argue that simply because they were pushing up their own very limited number of securities in which they traffic. People don't understand that. You have to elucidate that also, why that is. But that was all arguable. But now we've got some proof, because now we've got a 20-year track record for ETF-based index investing. And history is spoken, and they are found wanting. So the S&P 500 for the last 20 years is got roughly a 4.5% annualized return.
Okay.
If you go to the MSCI All Country World Index, less than that, yes. Maybe 3.5 or 4. If you bought a 20-year Treasury note mm-hmm. at year-end 1999, mm-hmm. you could have bought about a 6.3 or 4% yield.
Remember it well, yes.
And you could have done just fine. So they didn't even perform as well as, call it a risk-free Treasury. Well, 20 years is a long time. And then, if you take another look at what we think is the primary risk to investors and the primary responsibility of an investment advisor is not comparable returns to some other manager or to some set of managers or to some abstract index or an index with some abstract purpose or importance, but at the very least to maintain someone's purchasing power over time and hopefully to increase it. Well, the measure of monetary debasement over these last 20 years, M2 money supply expansion, has been more than 6% a year. So in that sense, if you owned the iShares S&P 500 index over the last 20 years, you actually lost in purchasing power.
How do you disaggregate that, though, between the outcome versus the process, right? Because if I were to point to active manager performance, almost by definition, it has to be worse, right? Because we've seen, in aggregate, active managers underperform the benchmarks.
But what are the benchmarks? What if the benchmarks are rigged?
Okay.
Okay,
So
which is
does
what
that
we're going to
mean?
be talking about here.
Yes, exactly.
So, well, by the way, I should preface this by saying I'm willing to try to defend it, and I feel comfortable with that. I think this is not just the United States, but globally, we're in the biggest financial bubble ever. That includes stocks, includes bonds. Basically, it's the entire set of financial assets worldwide. And it doesn't happen in a vacuum. It happens because it's unprecedented, but it follows on the heels of something, and there's causality here, something else that's unprecedented. There's never before been a coordinated global coordination by the world central banks to drive interest rates down to these artificially low rates. Now people have caught on to this. I have books at home that have the evidence, the lowest interest rates in 5,000 years. One of the things that's happened is that it raises financial asset prices, makes people feel good, but it's actually very pernicious because it transfers risk and returns between savers and borrowers. So if you've done everything you're supposed to as an individual, you're an retired accountant, or you're an attorney, you're a doctor, and you've paid for your house, and you've got $1 million, $2 million saved up. So what's $2 million times, if you put it all into a 10-year U.S. Treasury note at less than 2%, and it's taxable. But even if it's not taxable, what do you get? You can hardly live on that if you don't expect to spend your principal because you don't know when you'll die.
Yeah, it's a pretty extraordinary statistic.
It's a crisis. Well,
Yeah.
So I like to differentiate. There's a term statistic, and then there's a place for interpreting for people, because it's really a crisis. It's a yield crisis, and people can't get yield. And what does that do? There's a dynamic to bubbles. They build over time, and people owned a series of bonds, municipal bonds or corporate bonds, or within a bond fund, and little by little there are maturities and calls, and the yield goes down because the coupon goes down, or the average coupon goes down because they replace it with lower coupon bonds, and it happens slowly. But little by little, people realize they've got a problem. And so Wall Street is a unique industry among other respects, that is the only industry I know of in which, if there's sufficient demand for a product, they can create effectively infinite supply almost instantaneously. If someone likes a certain kind of GM truck, they have to retool, there's a certain amount of capital they got to put in, but they'll sell you whatever you want. Okay. So what happens? Some firms see, there's a need for yield. Why don't we create, it also helps the fee aspect, let's create a dividend aristocrats ETF, an index. And so you've got various kinds of companies, they collect them, the higher dividend yields. And so people, they go where they're led there. So you get less than 2% in a treasury. And I said, look, you can get 3.5% in this REIT index, or this dividend aristocrats index. So they put more money into bonds than they really should. Into equities than they should. They're doing what they can. So then you have the dividend aristocrats fund and so forth and so on. But it's important to understand the magnitude of asset flows into index funds. And we're talking about several $100 billion every single year for a decade. It's actually been climbing until this past year. And what happens is, when you have trillion-dollar asset managers and they create a new fund, and it could be a $200 million fund, a $400 million fund, a $500 million fund, and there's going to be a knockoff at one of the competitors. As a pure business proposition, you've got some really bright people in the back office working up different packages of stocks, new indexes, and They try to make it work. And let's just say that they create a list that backtests really well, that's got a nice theme to it, and then they bring it to their managers, and the managers say, well, there's a problem here, is that you've got these 100 stocks, except in the nether regions of that list by market weight, the ones at the bottom, they just don't have the trading liquidity. They've got so many shares per day of trading, and they're an X percent, let's say it's equal weighted, and it's X percent of your list, and we can't go above certain liquidity limits that we set in place. We can only raise $100 million for this. It's not even worth the time. Barely pays for your salaries. So they go back to the drawing board and they fiddle with the rule set. It's a very simple rule set. And they simply drop out. They find a way to drop those companies out. And it's legitimate to say, we have this list, but only companies with above this much trading liquidity or whatever. So now you drop those out. And suddenly you can raise $500 million. That's an example of why, in real practical purposes, the ETFs, whether they're bond ETFs or stock ETFs, have trafficked substantially completely in large cap and mega cap stocks. They really need basically industrial strength trading liquidity, which is why you find ExxonMobil everywhere they can put it, and why you find technology stocks in funds where they don't belong, because Facebook's really liquid, or Microsoft's really liquid. They'll find a way. You can find individual stocks, like an ExxonMobil or a Microsoft or something else, and you'll find they're in growth ETFs, they're in value ETFs, they're in momentum ETFs, they're in fundamental tilted ETFs, they're in dividend ETFs. They're everywhere.
Yep.
It defies, if you actually look at it, it defies logic, other than they need the trading liquidity. There's so many systemic risks in the market now. What'll happen is, when something gets overdone enough, when you get a deep bear market, you get a bubble, aside from the fact that they can go higher than you ever imagined, more overvalued than you ever imagined, or lower, there become a variety of systemic risks. And one of them nowadays, systemic risk meaning it's going to affect substantially most of the securities in the universe you're talking about, a single variable. And one of those variables now, I know you've observed it, or I don't know if you're concerned, but certainly you study it closely, is the concentration risk. So people are unaware of what the concentration risk now is. They think they're getting diversified. Diversification semantically only, just in name, because all the same stocks are being owned by these ETFs. The fund flows come in. The ETFs the indexes are price agnostic. There is no, in their short list that makes up the rule set for inclusion or exclusion in the ETF, market cap, industry sector, PE, whatever it might be, those descriptive attributes, there is no place for valuation. There's just not, it's not on that list. Here's the different ways to talk about the concentration risk. So not too long ago, only a matter of weeks ago, I counted up in the S&P 500, the top 100 names. It's 20% of the names. I counted. It just happens that the numbers are this even. 67% of the market value of the index. That's real concentration. I don't know if we've ever had concentration like that before. They drive the market. The asset allocation, this idea of shifting from one sector to another in terms of market capitalization, it can't happen anymore. So I think the figures for the Russell 2000, is that $2 billion and below?
I think it's a little higher than that actually now, but yeah, something like that.
But the sum, the complete market capitalization of all the Russell 2000 stocks, it may only be several percent of the value of the Russell 1000, the S&P 500. So even if, for the sake of argument, it were undervalued, let's say it were undervalued, and people just wanted to shift some money there, they can't. You can't have a thimble that's a 5 or 6% size to accommodate that. So in one sense, people they don't know it, but they're stuck.
Yep.
They're stuck in these large, there's nowhere to go. Are they going to go to treasuries and earn basically a return that will impoverish them? I want to talk about that too, because the lie or the complete, let's say, misapprehension of indexation. Talk about active managers, you asked me before. So this is a long-winded way of getting around to this response, which is that the indexes have been buying automatic bid.
Yep.
Every time money comes in, they're required promptly to buy in all the stocks they own in the precise proportions. They've been buying their own book. And it's arguable, pushing them up. So, therefore, this is not passive. They're not participating in whatever the clearing price mechanism is established by active managers. In fact, one of the reasons why active managers have done more poorly is they have been the bank of funds. There are places to look. You can see on a given year, a given quarter, so much money comes out of active managers, and pretty closely, that's the amount that goes into indexes. So they've been the bank providing that. Therefore, like Marigabelli, you might like what he does, you might not like what he does, but I'll give him this. He sticks to his knitting. He hasn't bent. He's not going to do what he doesn't want to do in terms of his, let's say, the integrity he has over the investment process. He loses money every quarter, but he's got to sell when you get redemptions. He's got to sell things that aren't in the indexes. There really is no buying interest. So he owns undervalued securities, and he's selling them, making them even more undervalued. Mm-hmm. The system is kind of gamed. I don't think the conclusion on that basis that indexes have proven active managers to not be able to perform as well as indexes, false. By the way, there's another anecdotal bit of information I like. I made a list a year or so ago of like a half a dozen really well-respected value managers who had 20, 30 years of ongoing investment performance obviously over multiple cycles. Superb performance, like really stellar, well-respected. Not anymore. Why? Because in the last 5 or 10 years, they've underperformed. Last 5 years, the underperformance year by year and back to back, astounding. We're talking about not just 5 percentage points, 10 percentage points, 15 percentage points a year. So if you take people like Gabelli and Chuck Royce and Sequoia Funds and so forth and so on, even Carl Icahn, first of all, there's information content in that. So how can you take, let's say, half a dozen or 10 people like that with proven serial success, and suddenly in the last 5 years, and by the way, they all have different approaches. They have an affinity or skill set for a different portion of the markets or style of investing or method of doing it. There's very little overlap in their portfolios. Mm-hmm. And suddenly, all together, they got stupid or incompetent at the same time. It's just quite improbable. So therefore, there's information content in that, which is maybe something else is going on.
Yeah.
And I can talk about why the S&P 500 has underperformed for 20 years, the Old Country World Index has. I can get into that. But before I do, because that's more specific, another more overarching observation. Have you heard of or read the Benson binder study?
No.
You're going to like this.
Okay.
I know what you're going to read at some point in the next week or month. My business partner, Murray Stoll, came across this, and he wrote about it. Let's call it the academic invalidation of indexation as practiced. Mm-hmm. Okay. So this is this guy, Hendrik Bessenbinder.
Okay.
It sounds like someone from the 19th century, but he's
Or Germany, but yes.
Yeah, but he's a professor at Arizona State University.
Okay.
And 2 years ago, he published a study, which is a 90-year study of equity returns, 1926 to 2016. But it's entirely different than what we're used to. It was called, a little insouciantly, Do Stocks Outperform Treasury Bills? And I have to tell you, this is a seminal piece of scholarship. And it's like a significant contribution to the field of the study of finance. And essentially invalidates indexation. So what he did is, the difference is that, I used to wonder about this. The reliance as a standard, this is the way it's supposed to be, when you measure performance returns for people, it's all based on this time-weighted percentage rate of return. Mm-hmm. But that's because it's designed for institutions, mm-hmm. how to compare managers. Mm-hmm. But individuals, they need to measure their performance in dollars. But that's not how it's done. So all the studies are done that way. And the difference is that his study was based on dollars of wealth creation.
Okay.
How much did each company over that period of time contribute in terms of dollars of value increase,
Right.
as opposed to just percentage return? Because that only I say only advisedly, only compounds at 12% a year for 20 years, which is actually really good,
Yep.
and creates a lot more dollars of wealth than some small company that on a percentage basis is a rocket ship for 10 years, but doesn't really have that much impact on the total index. So this study encompasses over 25,000 different stocks.
Okay.
Of those 25,700 stocks, only 1,092, about 4% of the total, were responsible for all of the $34.8 trillion of wealth generated from the equity market between July 1926 and December 2016. 96%, the other portion, of all equity studied performed no better than Treasury bills. You can draw some very quick conclusions from that, or propositions. So indexation, as practiced, purports to be a representation of market reality, but it really doesn't mirror market reality. That's not how the market works. So if 96% of the securities don't provide a higher return than Treasury bills, then when you trade one stock for another, you only have a 4% chance, about a 1 in 25 chance, that the new position will outperform cash. So that's the best argument I've heard so far for buy and hold investing. And as to that 4%, that's why indexes ultimately undiversify themselves. So we were exercises about this a long, long time ago, that you just buy a list of stocks. This has to be large enough to encompass a normal distribution. And whether that's 20 stocks or 10 or whatever it is, 30, most people say 35 statistically is a good number, and you just don't touch it, then the two smart ones, and you don't know which one is smart in advance, they will outperform over time. And over time, the performance of the account will converge upon the performance of those two stocks. And the account will get more and more volatile, but it'll also outperform. The thing about indexation, though, is for a variety of reasons, it can't permit that to happen. Number one, they've placed caps or limits on what a position size can be. And number two, there are constantly new entrants. Uber comes along, IPO. They have to make shelf space for it. They have to reduce. So they get diluted over time just in a natural way. So anyway, as practice, one can see why ultimately the indexes can't do as well as, for a variety of reasons, the historical returns suggest.
Yeah, I think there's definitely some truth to that. I think the underlying dynamic of survivorship bias, the inability to fully participate. The other component, of course, is that the participation of the individual is not reflective of the performance of the index, right? Particularly if you're buying in an ETF where you're paying bid versus ask, which can be quite narrow but accumulates over time. To me, the most interesting thing that's happened with the index space, though, is actually almost the exact opposite, right? Because we have functionally locked in a group of stocks that money gets continually piled into, right? So the most popular mutual fund is the Vanguard Total Market Index, right? Where functionally every stock, there are some that are excluded for sampling and liquidity purposes, exactly as you're describing, right? Which get excluded and then continue to underperform, which naturally draws the eye of astute value investors such as yourself, which locks in potentially underperformance even as you're accumulating a greater ownership of an undervalued asset relative to an index that's playing off of momentum. You know, that type of dynamic perversely actually ends up really damaging the capitalist system, right? Because companies participate regardless of their underlying fundamentals.
Yes. Now, I've changed the way I talk to clients about the market and the bubble and so forth. What I do find people can readily assess are bonds. Bonds have many fewer variables. You've got a coupon, you've got a maturity date, And if it's money good, you're getting 100 cents on the dollar at the end, period. If you're not sure it's money good, that's usually pretty determinable. That's not such a mystery usually, right? Okay. So I now can use this to talk about the falsity of the way modern portfolio theory and efficient markets and blah, 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 the way that portfolio management is practiced on an institutional basis, which filters into these asset allocation models, which induces people or their investment counselors to put them into certain asset classes and certain indexes and so forth. The basic false premise of it. Okay, so you mentioned the most popular ETF by size, which is the Vanguard Total Market. Well, in the bond realm, the fifth largest ETF is the iShares 20-year plus Treasury ETF. TLT is the ticker. And last year, actually through November, it got $7 billion of new assets, which increases assets by 65%. Spectacular. So the problem is that the average investor who owns TLT probably thinks they did pretty well last year, and they're very pleased with it. And they think it's a high return, low risk investment. Why? Well, first of all, it's up 14% last year. What they don't look at necessarily, or know to look at, is that the average coupon is not even 3%, 2.99%, which means that 80% of the return came from appreciation. And that appreciation only happened because the government lowered interest rates, or the interest rates were lowered, got lower. And, okay, well, what if they say, what if that keeps getting repeated? Well, there's obviously a limit to that. Even so, the yield to maturity is still only 2.29%. You hold that for 20 years, the same more or less, you could expect that's what you're going to get. And that is below the rate of inflation. So the government is telling you that you are guaranteed for 20 years to lose purchasing power every single year. And if M2 money supply, which in the last 20 years has been 0.2% or so, last year it was more like 7%. The last 6 months it's more like 9% on an annualized basis. That's monetary debasement. So if you're going to lose 4% in terms of purchasing power every year, that means in 10 years, the $100,000 or the $1 million you put into those 10-year treasuries, those 10-year treasuries will be worth half as much in terms of purchasing power. You could be in real trouble if the amount of income you're able to get off that was just enough for you in year one. So that's an existential crisis for people, and they kind of sense it, but they don't know how to evaluate it in terms of what they're buying. So the other problem is how Wall Street describes risk to them. So if you go to the TLT website, right on the main page, I'll tell you, it's got this duration, it's got this convexity. I don't know what that is. Well,
You know what it is, but yeah, I understand.
Investors aren't conversant with that. What they don't know in terms of risk, if 20-year interest rates, just sake of argument, next year, go from just 2.29%, which is what that yield to maturity on that is, to 5%, that they're going to lose 30% of their investment. They don't know that.
Perversely, though, if that happens, because of the higher coupon, they'll actually end up with a higher total return over that 10-year period, right? So while the immediate impact would be negative, and I spent a bunch of time digging into exactly this topic post the global financial crisis, because I was trying to understand what are the real risks in bonds, right? And the real risks in bonds are exactly as you're describing, that the rates go low and stay low forever, right?
They could stay low. Well, I'm convinced, and this is completely unscientific, it's completely non-technical. I'm a big believer in incentive systems and basically behavioral psychology and behavioral finance, is that interest rates will stay very low if the government can help it for a very, very long time, if it can help it, simply because it can't afford for them to go up.
I agree with that.
And they'll do whatever they have to. Now, eventually, it could create a real crisis of one sort or another.
think the interesting challenge is thinking about it from the standpoint not of a valuation system, right? Which most people tend to focus on the idea that low interest rates translates to higher valuation, right? But you've referenced M2 a couple of times in this. We live in a collateral-based credit system, right? So what happens when the government cuts interest rates? The price of the bond goes up. What does that do? It provides you with additional collateral to then go and buy stuff, right? It's theoretically worth more, even though it's going to depreciate towards par, right? And so I think that is actually one of the key underlying dynamics, right? We've effectively built a system predicated on collateral. It's not that the interest rate is really what's driving it.
Yeah.
It's the bond price. So what do you see as the alternatives?
In today's world, we have basically a bifurcated market in terms of clearing prices and how those clearing prices are developed. And that is either you're in the indexation, above the ETF divide, you're in the indexation sphere of activity as a security, or you're not. Now, if you've been excluded by the relatively simple rule sets of the ETF universe because you don't have you might even be a large cap company. I name a company, I'm not recommending it or not. AP Moller Maersk. I forget, the market cap could be 30 billion. It's the largest shipping container company in the world. But aside from the fact that it's not a U.S.-based company, but even if it were, I think it's the Muller family. I don't remember, they own 45% or 55% of the shares. Therefore, the effective market cap is way, way lower. It doesn't suit. It also doesn't have the volatility or return characteristics you might want because shipping industry has been in a depression for years. So that's not going to be in an index. Okay, so what will happen is, if you're below what I call below the ETF divide, there is no institutional, for all reasonable purposes, virtually no institutional interest in you. There aren't any analysts covering you because they can't get paid to cover you.
Yep.
And therefore, for the first time in my career, which only goes back to 1982, you can have companies, you can get a free lunch. Now, there is no free lunch. You have to figure out why it seems free. Otherwise, you're on thin ice. You can get a free lunch in all sorts of ways because the excesses in the indexation-centric securities market has created deficits in clearing prices and valuations in below the ETF divide. So what will happen is that there are companies now that are undervalued, not for any fundamental reason, meaning fundamental having to do with their balance sheet or their income statement or competition or technological displacement or regulatory problems or management issues. How can you find a decent company trading at a low enough price that you think you're getting some discount or margin of safety? Very, very difficult. You really couldn't. What you needed to do traditionally is find some company with a blemish. The CEO absconded, they lost a big contract, whatever it might be, stock drops. Then our job is to try to evaluate that and find out whether that insult is transitory or permanent, whether it's structural or superficial. I say, you know what? In 2 years or 3 years or 4 years, somewhere beyond the standard institutional investment time horizon, they can't take the time risk. I'm willing to take the time risk. That's one of my advantages. Is it'll be fine. In which case, what's normalized earnings on this? And what's some kind of a normalized, perfectly average valuation? Oh, I'll do pretty well. So I'll buy it and wait. That's what you have to do. But now, for the first time, you can buy companies that are deeply undervalued relative to some objective measure, their assets, and their assets are profitable, or their earnings, or their free cash flow, whatever it might be, good balance sheets. There's no blemish on them. And but the reason they're cheap is that they've been excluded from the indexes, probably either for one of two reasons. They don't have sufficient trading liquidity, large company or small, or they don't fit the shape parameters, meaning it might be a trust or it might be some odd kind of, it might be a multi-industry company. It's not exactly, it might even be a real estate company, but it's not a REIT. They want REITs. They don't want land development companies. So what's happening now is that if you're willing to look, if you have the license as an investment advisor to look below the ETF divide, you can find everything you want. So it's possible. It's really possible. You can create a portfolio with bonds and other kind of income securities, other kind of equity securities that's got, let's say, give you an example. Let's say a 4% gross yield, dividend and interest, some of which is tax exempt, that has important strategic flexibility, let's say 20% cash reserves, that also has both bonds and equities in there that have plenty of optionality or of a high order, contingent of course, or modest but steady state internally generated growth in shareholders' equity over time and therefore income reduction. So you can get a yield that's twice the 10-year Treasury rate. You can have purchasing power protection. You can get everything you're supposed to have. Now, is it going to track what's happening in the marketplace? No, but that's not my goal. I have a different objective. Mm-hmm. You can do that, but you can't find it in the same with bonds. I heard you discussing this, is that you find a bond that's, to your valuation, perfectly good. It's money good for the next 4 or 5 years till it matures, but it's not an index. It might not be a large enough issue. You can buy a 7% yield, and it's not a junk bond.
Interesting. Well, I think that's going to be the interesting question, right? And a lot of the dynamics that you're discussing, we both experienced in 99 to 2000, right? Similar components. I've talked about home builders right before the big housing bubble being priced at half of book value, right? The challenge in my mind, and we referenced it a little bit before in the discussion, is that we have actually created such a fundamental flaw in the structure of how assets are collected and how money comes into the system, that it's not clear to me that we're going to be able to capture those mean reverting characteristics that you're highlighting. If 95% of the money that comes in, if millennials who are going to be the millennials and those who come after them are fundamentally forced into passive investing styles because of regulatory systems, right, and gain no experience whatsoever, right, are we setting up the conditions in which we destroy those mean reverting characteristics? And I would highlight as a good example the travails of FedEx relative to Amazon, right? So Amazon functionally has a zero cost of capital because of the dynamics of inclusion that you're highlighting, right? And so they're able to make investments that would be uneconomic for almost any company to make, certainly a large-scale logistics company like a FedEx, right? They've been able to build a second FedEx, something we would have thought of as having a giant, significant moat for an extended period of time. They've been able to replicate it in the period of roughly 3 years. The real fear that I have is that we've broken that characteristic. And I think it's going to be fascinating to see if it reverses itself.
Okay, you bring up 2 points, which I spark some responses. So one is, you're pointing to something that people forget generationally. So every generation, there are some companies that for 20 years, 30 years, grow and grow and grow, and they become recognized. And in the course of someone's life, their personal experience, they've been there forever. Mm-hmm. They're stable. But that's not how business works. They're not stable. But what will happen is, that's another reason why indexes have trouble doing well, which is that another reason why you get this 4.5% annualized return since 99 for the S&P 500, is if you look at the largest 10 companies in the S&P 500 at the end of 1999, most of them have suffered displacement by competitors. So IBM was displaced by cloud computing, and Dell was displaced by the emergence of the iPad, and so forth and so on. That's natural, because the largest companies represent the easiest, largest targets for a nascent competitor to secure customers and revenues. And people think that an Amazon or a Facebook or a Google are somehow impervious to technological displacement. And if you take a look, there are a whole variety of companies and technologies, or just plain old competition that is beginning to make inroads. We don't know which will work or not, but to give you a non-technological form of what can happen. The margins, the returns on equity of the modern information technology companies like Facebook and Google and so forth are simply enormous. So the stated ROEs might be 30% or something like that, depending on the, but really, you take all the cash and marketable securities and non-marketable securities on the balance sheet, which are non-productive, they don't need them to do the business. You take that away, the returns on equity could be 50, 60, 100%. It's simply like unheard of. It's not really sustainable. Someone's going to come after that. Now, how can they come after it? Well, Dell, which displaced all sorts of other companies in manufacturing PCs by doing a direct-to-consumer approach, and they were willing to sustain a lower profit margin to get there. Dell is now getting into cloud computing. So what does that mean? You set yourself up a warehouse, and you buy all the equipment, and you do it. So now they're going to compete. By the way, there's a food fight going on now. Amazon and IBM. IBM needs to succeed in cloud computing to protect itself now. And Dell's getting involved, and Amazon. At some point, there's going to be margin compression. One of those players is going to be willing to take a lower margin, just like in ETFs. Here's why I don't think it can keep going on. So, we talked earlier, the bank of funds for suctioning out of active management into passive management, that's finite. As of a year ago, I think it was a Fortune magazine article, they did a study. They thought that we passed the 50% dividing line, a very significant one, of all passive assets as a percentage of all investment assets in the public markets. And that has all sorts of implications, and you've observed them yourself. There's a law of large numbers. So now there's 50% float available to them. Now it's less. Now it's 49, if that was a correct number, or 48. Every year, in order to maintain the same kind of constant pressure on the automatic bid on all the stocks owned by all the ETFs and bonds, they need larger inflows each year. If it was $350 billion last year, whatever the number was, now it's got to be more. But the pool from which they're drawing is getting smaller. Something like that can start to accelerate real fast. When the flow of funds into indexation slows, or stops, or turns negative, there's no more automatic bid. And the marginal trade, which is effectively indexation has been for the last 10 years and increasingly in recent years, the marginal trade, like the baton, is handed over to the active manager. And the active manager, I just referred to Mario Gabelli because it just occurs to me, he's not buying a blue chip, he's not into technology, but he's not buying a now mature, trending into cyclical blue chip like Coca-Cola or McDonald's or Procter & Gamble, which have actually had sales declines in recent years at 25 times earnings. Just not doing it. So where's the bid going to be? This is before we get to other dynamics.
So the pushback that I would make to that is that the old people, for lack of a more descriptive term, are the ones who own active managers. The young people who continue to have inflows are those who own passive vehicles. There's nothing that actually says that active manager ever gets to bid again. There's no rule of the universe. There's no law that says that has to happen. It's unfortunately catastrophic, but there is no law that requires that. That, I think, is going to be the really interesting question, is if the system
I'll give you another one.
Self-regulatory. Sure.
So the rules, again, when you get extremes, you get other possibilities. So since it's fully disclosed the precise percentage positions in every single ETF. You know exactly what they own. You know how many total dollars of assets are in every single ETF. At a certain point, if the inflows get small enough, even with a lower age demographic making contributions, it's going to start to peter out. And we don't know. I've never worked these kinds of numbers the way you have. But at a certain point, if it looks like it's tipping, you can have short sellers who know if there are going to be any redemptions, net redemptions, they'll know exactly how much is being sold of every single security. And they have almost like unlimited quantities of assets that they can front run. That's a different kind of scenario.
Yeah, so I've worked through the numbers, and I think it's going to be interesting to see how it plays out.
You think it's more dynamic than that?
I think it's more dynamic than that.
Yeah.
I think the real risk is that we've seen short sellers already eviscerated by the inflation that I think is caused by the passive investment process.
But the passive investment process has still, and that's why those short sellers are missing an important element. Money's flowing in to the tune of hundreds of billions of dollars a year. You can't get in front of that.
Well, to your point, though, that money is coming out of the active managers and flowing into the passive.
Yeah.
Ironically, if you have that inflation, the supply of assets that's available to the active managers goes on much longer, right? And we've broadly seen this. I mean, there's very few stocks, you highlight it yourself, unless they're unless they're outside of the indices, right? Which Vanguard Total Market Index, there's very few stocks that actually are outside of that unless they fail to meet float dynamics or ownership dynamics.
Yeah, but if they're 1/100th of 1%, they're in a de facto sense, but it's meaningless, statistically meaningless.
Yeah, no, I think that's right, but that's exactly the point that I'm making, which is the assets that are owned by the active managers, who by and large buy stuff with similar characteristics to the passive indices, you being one of the notable exceptions, they can experience that same inflation. And so one of the big pushbacks I have is the idea that value stocks are cheap as they were in '99. I don't see that at all. I think there's elements exactly as you're describing. I think we're going to run out of time, but one of the things that I think is going to be so interesting, and I'd love to come back and sit down with you in another year, is this underlying question of, is there a self-limiting feature, right? Can this actually wrap back around?
I think what's going to happen is there are going to be some serious social problems.
I agree.
When you see serious tumult in nations, social tumult, it really often follows when there's been currency debasement, loss of purchasing power, inability to live on your investments or your income. People get desperate. Then things change. Desperation. And we're heading in that direction just a lot more slowly than Greece or Venezuela.
I share those sentiments exactly.
So I have to mention one term that's necessary for anybody who I talk to hear, whether they are willing to let me work with them on it or not, is the ultimate hedge against currency debasement. It might never work, it might never be necessary, but it can save your financial future. And it can be done in such a small amount that it will never harm you if it doesn't work, which is a fixed issuance, meaning non-debasable cryptocurrency. Because if the time ever comes that people in various parts of the world feel they need a non-debasable currency, the returns can be on the order of hundreds of times your money.
Yeah, I share those sentiments. Historically, it would be gold. We don't know if going forward it's going to be a crypto asset. But I agree with you that those types of nonlinear properties are become an important part of any asset allocation framework.
Yeah.
So I really look forward, Stephen, to sitting down with you again
Been fun.
and sharing these thoughts.
I actually enjoyed listening to you more than talking to you. Yeah, because I was doing the talking.
It's great seeing you.
I was doing the talking.